In today's video, I'm going to tell you why you shouldn't pay off your 30-year mortgage in 8 years. I'll start by explaining some strategies for how you actually can do it, because that's probably something you care about. Plus, this will lead us into today's topic. The first thing you should know is that, even though most mortgages in the United States are taken out for 30 years, on average a mortgage in the US actually lasts between 8 and 10 years. In other words, when we buy a house, we get a mortgage to pay it off over 30 years. But that particular loan in the US typically only lasts 8 to 10 years. Most experts who talk about this topic won't tell you this, because they research how things are done, but they're not actually part of the lending industry in the United States. I'm a federally licensed mortgage originator in the United States, and I'm going to tell you how things really work from the inside. Let's start with the strategies to pay off your mortgage in less than 30 years. You wanted to know how, and I'm going to tell you. The usual strategies you'll see in other videos simply tell you to pay more. For example, they tell you if you want to pay it off in 10 years so it really becomes yours, or if it's an investment so you can actually make money. There are two very important concepts you need to keep in mind. Even after your house is completely paid off, you'll still be paying taxes and insurance for life. And many of you might think, okay Alberto, I already knew that, that's nothing new to me. Well, it's very important that you keep this in mind because we'll never be free from making a monthly payment for your house, just like we'll never be free from having to buy food or put gas in the car. Don't think that paying off your house is the end. And I'm not telling you this to make you feel bad, but to bring a bit of realism to that emotional need we have for a paid-off house, one that gives us peace of mind, that gives us certainty. Maybe you should look for that peace of mind and certainty elsewhere, and not be in such a rush to pay off one of the many debts you might have. If you want to pay off your house, or if someone has recommended that if you pay off your house very quickly, in 10 years, and it's an investment so you can really enjoy the benefits of that investment, you should know that for an investment property to actually be profitable for you, you need to do the math and crunch the numbers before buying that house. Because an investment property should generate net income for you, sometimes right away, and sometimes in 2 or 3 years. By then, you should already be earning net income from that house. Not in 10 years, not when you finish paying it off. A good investment purchase should be profitable on its own, not just because you paid off the loan. Paying off your mortgage will free you from two very large, very important payments. That's true, the loan principal and the interest. But you won't be free from the taxes that are paid monthly through the loan. When your house is completely paid off, you won't have the commitment or obligation to make that monthly mortgage payment anymore. But you need to keep in mind and remember that your taxes and your insurance are obligations you'll continue to have and must keep paying. This is much more important than it seems. I know of a couple in Florida who, unfortunately, out of ignorance, bought a house outright thinking it was theirs, and it was, but because they didn't pay the taxes, they lost their home. So if you're looking for peace of mind by paying off your mortgage quickly, you need to take other things into consideration. Paying off your mortgage completely might not be the solution for you. You're going to hear and see in informational videos that it's about making extra payments. This isn't a secret and, well, there's some help in that advice, but at the end of the day, what they're recommending is to pay more, to take out more money. This actually does have something good that's important to mention. It's that your loan, whether it's for 30 years, 15 years, or 10 years, doesn't behave in a linear way. What does this mean? It means that if you make extra payments in the early years of your loan, the benefit will be much greater. Because banks, at the beginning of the loan's life, charge you a higher amount in interest, and as the loan progresses, the interest decreases in proportion to the principal. If you want to make extra payments, it's very important that you make them at the beginning of your loan. In the first years, the first 5 years of your loan will have a much greater impact. Maybe that's not possible for you, and that's okay, but just be aware that during the first years of your loan, most of the money you're paying is interest, and that's just the reality. We're not going to say whether it's fair or not, it's just the way it is. The first strategy they tell you is to make one extra payment per year, and with this, on average, you'll reduce the life of your 30-year loan to 23 years and 10 months. This is a big advantage, and it's really good to make one extra payment per year. An easy way to do this is to divide it over 12 months. The second strategy, make half an extra payment each month. This will reduce your loan term from 30 years to 12 years and 8 months. The third strategy, pay double every month. And with this, you'll pay off your loan in 8 years. Really, there's no big secret here. It's simply that if you pay more, the life of your loan will be reduced. But it is very important for you to know, because you probably haven't considered it, that those extra payments you make have a much bigger impact than just a single extra payment. That extra payment you make each year eventually turns into almost 3 payments. It's almost triple the savings. In other words, if you make a payment today, it's almost like making 3 payments at the end of your loan. That's something really important to know, and if you have the ability and the interest to make extra payments, it's a good strategy, always recommend it. When you're going to make extra payments on your loan, it's very important that you specify on the bank's website how you want that extra payment to be applied. The bank has several options for what to do with that money. Normally, what you want is to simply apply it to the principal so that your term or mainly your interest decreases over time. This is very important because the bank websites where you make your payment will have other options. For example, if you want to assign the extra payment to escrow or the escrow account, which isn't what we're interested in if our goal is to reduce our loan, or for miscellaneous payments, which we also don't want to select. What we want is that when you make an extra payment with the goal of paying off your debt early, you apply that payment in a specific field on your bank's website called principal. We've already mentioned that one of the reasons not to try to pay off your mortgage early is because loans usually don't even last 10 years. So, if your loan isn't even going to last 10 years, it might be a bit pointless to worry about solving a problem that's simply never going to happen. But for me, the most important reason why you shouldn't focus on paying off your mortgage early is because most of us, besides the house, have many other debts like credit cards, where the interest rate is much higher than on our home loan. Car loans also have higher interest rates. If you're thinking about paying off your house quickly so you can buy the next one, in a video somewhere they mentioned that if you make these extra payments, in the end, after 30 years, you'll have $25,000 or $26,000, which is the down payment for another house. I don't think it's the best strategy to have to wait more than 20 years to be able to buy your next house. What I recommend, and that's why I talk about not paying off your house early, is first, pay off all your more expensive debts first. Second, if you don't have any debts or you have a more aggressive investment strategy, instead of putting that money toward extra payments on your house, save it to buy your next house. So, instead of having to wait more than 20 years until that house is paid off and you have those $26,000 to buy your next house, save them now, save them yourself, and you'll be able to buy your next house in 3 or 5 years. In less than 10 minutes, we've already gone over the strategies you can use to pay off your house early, and I didn't show you any charts, I didn't show you an Excel sheet, I didn't show you any numbers because something very important that you should know, and it's really good for you. These early payment simulators for your loan. Listen to this. You can find them on the website of the bank where you have your loan. I haven't seen this mentioned in other videos. It's very important. That's why I'm going to repeat it. If you want to simulate what benefit you get from making early payments on your bank's website, for your loan, that's where you'll find it. You can find it as Extra Payment Calculator, or on other websites, there's a section called Pay a Lump Sum. Make a large additional payment. And it will simulate how you would benefit over time by making these extra payments, whether small or large. You can see on your bank's loan page how you would benefit if you make additional payments. Other banks show you this information in a section called Education and Goals. If you can't find it or don't know how to look for it, I'll leave the link to my personal page here where you can see how your mortgage payment is broken down. With a payment simulator for 30 years or 15 years, depending on different features you can enter there, and you can run simulations yourself. But it's very important for you to know that every extra payment you make on your loan will multiply by 1, 2, or even 3 times. In fact, making additional payments on your mortgage is a huge benefit. A very simple strategy to do this, which is actually a strategy you might be interested in, is to round up your payments to the next $10, or add $10, or add $100. Whatever you can manage. You can also refinance to a shorter term if you're really aggressive about your payoff goal. Maybe you currently have a 30-year loan, and it might be a good idea to refinance to a 15-year loan. Remember, if you want to buy a house with a loan or pay cash in the United States, you can contact me for a free consultation. And consultations are free, always free. However, you might already be thinking about it right now. It's very important that if you got your loan 2 or 3 years ago, the interest rate you have on it is ridiculously low, and it's not worth it for you to refinance. Just make extra payments. Another option you can consider is to do a loan restructuring, which is not a refinance, but simply an agreement with the bank if you suddenly come into a large sum of money, $20,000, $30,000, $50,000. You can talk to the bank to do something called a recast. This is a restructuring. It's not a refinance. It's a restructuring of your loan so that by making a large payment, your monthly payment can go down. This is another strategy you can use. Do you really think that the money you're saving will actually be sitting in a separate account, saved up just for you? It takes a lot of responsibility and a lot of willpower to make sure that the money you save over the next 20 years stays set aside, because you say, this is the money I saved on the house, and since I saved it, I'm going to use it to buy the next one. That's why I recommend that instead of making those extra payments, you save that money and use it to achieve other goals, not necessarily to buy another house. It could be to pay for your children's education, to pay for your car, to pay off your debts, to buy yourself another car, to buy a vacation home, or to finally take that trip to Europe you've been putting off for so many years, and you'll keep putting it off until the day you finish paying off your house. No, life is now. You only get one life. For many of us, paying off the house quickly might seem like an excellent option because it gives us peace of mind. But the day you pay off your house, you'll realize that the peace you feel doesn't mean you no longer have financial responsibilities. You'll have financial responsibilities,